If someone offers to set up your financial future completely for free, you should immediately ask how they pay their rent. In the financial sector, there is no such thing as free advice. The cost is always there, it just takes different shapes. In 99% of cases, the person sitting across the table from you is a financial agent or broker. They act as a sales representative for a network of banks and insurance companies. The appeal is obvious. You don't have to write them a check or transfer an hourly fee. You simply hand over your monthly savings and they place your capital into professional investment funds. This waterfall chart visualizes exactly how that agent gets paid. The fees are baked directly into the products they sell you. On a typical €10,000 investment, banks pay the agent's network an upfront commission of up to 2.5%, immediately siphoning off a chunk of your capital. Then, they take a trailing commission of about 1% every single year just for keeping your money in the system. This structure creates a very real conflict of interest. The agent has a direct financial incentive to recommend the funds that pay them the highest commission, rather than the funds that generate the highest net return for you. You avoid paying cash out of pocket today, but you accept a heavy, invisible drag on your compound wealth over the next decade. The legal alternative to this system is a genuine financial advisor. By law, true advisors are strictly prohibited from accepting any commissions from financial institutions. Because the banks aren't paying them, you have to. They operate exactly like a lawyer or an accountant. You will receive an invoice detailing an hourly rate between 50 and €200, or a flat fee up to €1,000 for your financial plan. The benefit is absolute clarity. Because they receive zero compensation from the product providers, they work exclusively for you. The conflict of interest is completely eliminated. But the math makes this deeply impractical for most beginners. If you only have a few €100 a month to invest, wiping out your entire first month's capital just to pay a consultation invoice puts you in a financial hole before you even buy a single asset. This leaves most retail investors stuck. You have to choose between a free agent whose incentives are misaligned or an independent advisor you cannot afford. Technology has forced a third option into this market: algorithmic social trading. Platforms like eToro and their CopyTrader feature offer a totally different structural approach to managing your wealth. Instead of handing your money to a middleman, you use the platform's software to automatically mirror the portfolio of an experienced user, known as a popular investor. When they execute a trade, your account executes the exact same trade in real time, scaled to your budget. You pay zero direct management fees and zero success fees to the trader you are copying. eToro compensates them directly for bringing volume to the platform. This chart maps cost transparency against alignment of interest. Copy trading lands in the high zone due to skin in the game. Popular investors must deploy real capital. If they lose value, you lose value. You get aligned incentives because they act in their own self-interest. This bypasses the hidden commissions of the agent and the heavy upfront invoice of the advisor. However, it changes exactly where and how you absorb the costs of investing. Since eToro isn't charging you a direct management fee, we have to look closely at how the platform actually extracts revenue from your capital. The primary indirect cost is the spread. This is the tiny margin between the buy and sell price of an asset. For regular stocks, this sits around a fraction of a percent, roughly 0.05%, which you pay every time the copied trader opens or closes a position. The secondary cost is specific to European investors. eToro operates natively in US dollars. If you deposit euros directly via a credit card or bank transfer, the platform will hit you with a conversion penalty ranging from 0.5% to 1.5% of your deposit. You can neutralize that penalty entirely by routing your deposits through an eToro Money local euro account, which bypasses those specific conversion and withdrawal fees. There are also basic administrative guardrails. If you abandon your account and fail to log in for 12 straight months, you will be hit with a $10 monthly inactivity fee. By sidestepping the traditional 1% annual fee of an agent, you take on the responsibility of managing transactional spreads and navigating your own currency conversions. Removing the human intermediary from the equation also means you assume total responsibility for deciding exactly who to follow. Traditional mutual funds are notoriously opaque. You rarely see exactly what the manager is doing under the hood. Social trading flips that, making a popular investor's entire track record brutally public. This wireframe illustrates a typical trader's data dashboard. Before you commit a single euro, you have access to their month-by-month historical performance, the exact percentage allocation of their holdings, and a quantitative risk score from 1 to 10 that tracks their volatility. You also maintain total security over your capital. The investor you copy acts strictly as a data patent. They have zero technical access to view your balances, withdraw your funds, or move your money. Because you hold the underlying assets in your own name, you are never locked in. If a trader changes their strategy or starts taking on too much risk, you can instantly sever the connection, liquidating all positions at current market prices with one click. The real trade-off here is your time. You are stepping into the role of a manager of managers, replacing blind trust in a local broker with your own rigorous, data-driven due diligence. This comparison matrix lines up our 3 options side by side to clarify exactly what you are paying for. Looking at upfront costs, the independent advisor is the only model that will require you to write a heavy check on day 1. When we evaluate incentive alignment, the agent falls short due to hidden product commissions, while both the advisor and the copy trader score high, one through direct payment and the other through personal skin in the game. Finally, the ongoing costs. Agents drain your wealth slowly with trailing commissions. Advisors bill you for future reviews. Copy trading relies on transactional spreads and currency conversions. There is no perfectly free lunch in finance. There are only different payment structures. The goal is selecting the structure where the costs are transparent and the incentives logically align with your wealth targets. Here is a scorecard to help you evaluate if social trading fits your personal profile. To make this model work, you need 3 things: a strict preference for total transparency over comfortable promises, a willingness to hold US dollar-denominated assets, and the discipline to sit down and actually read a trader's performance data. Taking control of your long-term wealth means shifting your reliance away from traditional middlemen and leaning into technological leverage. Don't take marketing copy at face value. The best way to understand this structure is to examine the raw data yourself. Go to the eToro platform and search for the public profile of popular investor Lucas Novotny under the handle @Lukasco81. Review his multi-year historical data, his risk score, and his transparent holdings. See exactly what alignment of interest looks like in practice and decide if it's the right fit for your capital.